How's it going, everybody? My name is Antonio, and I thank you for being here. I'm sitting down with Brandon Munro today, about a year after our last conversation, and the company has released a definitive feasibility study, which is by the way, this is a study, just for background. This is a study meant to show the economics of a project, and it is definitive in nature because this is meant to be sort of almost the final study that of this sort, at least, that the company expects to make before it makes its final investment decisions from here on. So there is a lot to talk about here based on the DFS. But before I get into it, I want you to know that Bannerman is not paying for this interview, and I have no financial relationship with them. So the questions are all mine. The company does not get any editorial rights over the video, nothing like that. But I also want you to know that the conversation is going to include a lot of forward-looking statements and generally hopes for the future, as I like calling them. So you should be wary, and you should be approaching this skeptically, so to say. You just do more research instead of relying on talking heads on the internet. As the discussion will be general and impersonal in nature, it's going to include no financial nor investment advice of any sorts or any other advice whatsoever. So please do keep that in mind. And that all said, Brandon, thank you for investing your time with me today, sir.
Thanks, Antonio. It's really good to be back on your program.
Pleasure is all mine. I still don't understand what's wrong with the matrix that I get to do this, but I'm running with it and I'm enjoying it. So pleasure is all mine. You know, I see you're smiling, and I've seen you smiling in a couple of videos since you released that DFS. So I'm just gonna go ahead and assume that you're happy with what you're seeing, but the market isn't necessarily happy with it. It doesn't. I mean, the share price hasn't reflected your happiness, so to call it. Why do you think that is? What's going on there?
Well, I suppose if you're using the share price reaction to form the view that the market's not happy, I'd say that we've traded in line with our peers. The last few days have not been kind to the uranium sector. We were given a lead from North America where Cameco and Sput were both down more than 5%. So I don't think that's a measure of anything other than the fact that my entire uranium watch list was red on Tuesday and Wednesday. Now, it would be very unusual for an advanced technical study to create a share price catalyst. That's not really what advanced studies do. They're very thick with information. The headline numbers are designed by nature to be confirmatory. So it's not like a drill hole where you go, oh my goodness, like this is a new story. An advanced technical study, it's either going to be what it should be or it's going to be bad. It's never going to be great unless there's some new aspect to a project that's been released for the first time. So I'm not stressed about that at all. The data that I'm getting, which is predominantly conversations with analysts, conversations with fund managers, conversations with institutional brokers, and so on, they're all very impressed. So that's the market reaction that matters to me at the moment. And I think that's what's more indicative of what the market's going to think of this DFS once there's been enough time to really digest it and understand it. You've got to remember, Antonio, it's a 122-page document. And the analysts who follow us, they won't only be reading that. They'll be going back to the PFS as well and comparing those two and really getting to the nitty-gritty. And, I'm getting a steady stream of questions just to clarify things and make sure their understanding's correct. So as I've said to a couple of shareholders who've written to me and said, look, what do you think's going on? The investing community that can really move the dial, as in the analysts and the fund managers and the family offices, they're going to take their time digesting a study like this. They're not going to be hitting the bid straight away just because they've seen it come out. So I wouldn't be jumping to any conclusions yet on what the market really thinks, and certainly wouldn't be using the share price as a guide when we've had two really destructive days across the entire uranium sector.
Fair game. And we're going to be talking about this DFS, sort of try to dissect what was written in that whole report. Just maybe a slight tangent, by the way, before we get into it. I was thinking about what I said previously, that it's been about a year since we spoke. We were scheduled to talk a few months ago, but the call sort of fell through, and you were busy in the DFS. I get that, but I remember one question. I remember wanting to ask one specific question. So you sort of had published the PFS last year, I believe, after which you and one other director ended up selling quite a lot of shares at a price that's roughly twice as high as it is today. And I remember that you had explained that in the news release as well, was something to do with a tax liability that had come up on your end that you had to take care of. So sure, I get that part, but given that you know the market is you think that the market is beating you down, is not given the reaction to the share price that you would expect the DFS to eventually give you. Do you and the directors have any plans of buying back those shares, or going more heavily onto the stock, given that there's a discount on it now?
Well, I can't speak for the other directors because I haven't asked them that question. But look, let's just get something clear. My job is to run this company. My job is not to sit there and hoover up shares when they're being loose. We're a mature company. We're a real company that's buying a mine, that's building a mine here. If we were a small little junior who was fiddling around with an exploration project, then yeah, you can move the dial as management, buying some shares here and there. I do get frustrated when my performance is judged not by what I achieve and what the company achieves and what we're able to do with our project, which has been outstanding, hence the smile that I gave you at the start. But, whether I'm buying shares or not, we're a more mature company than that. We've got a DFS that's just come out on one of the largest uranium developments in the world right now. I'd really hope that investors are starting to look past that way of judging small, junior, speculative mining companies and start to look at what I am, which is a chief executive officer of the company. I'm not in this role because I've got a big bank balance that I can start buying shares with. And some of the examples that I've seen in the broader resources sector, and I don't want to be part of this crowd, you see examples of really poor management being excused because the CEO has the bank balance, the personal bank balance, to just buy up shares. So almost on principle, I want to be judged on my performance as a manager and as a CEO, not whether I'm dipping into the market constantly.
Fair answer. Fair answer. I guess where the frustration online comes from is that people would check the price at which you sold, and they would check the price into their brokerage account. They would be like, they pocketed a lot of money. I'm not making any money right now. And I do understand as a retail investor where that frustration might come from, but I do appreciate your answer here. So that makes sense.
Yeah, and look, to respond to that aspect, I totally get it. That is frustrating, but I didn't sell those shares expecting that we would be in this situation right now. I sold those shares because I had an immediate 7-figure tax liability. And unfortunately, if anyone's really got a problem with this, their frustration can only be as big as me. And the answer is to go to the Australian Tax Office and tell them that their taxation laws are ludicrous, that you get taxed on shares that you can't sell. So, yeah, as you say, we went into that in a lot of detail at the time. We really explained it. I'd love to be having this conversation when our share price is double that level, but we're not. And, I think the more constructive conversation is not so much what happened last year, but what's happened this week, which is we've released a definitive feasibility study with some really good numbers in it.
Sure. I agree. So let's talk about that. Let's talk about the DFS. Well, actually, you know what? There's also something that I was wondering about there. So it's called a definitive feasibility study. It's definitive in nature, but this is not the first definitive study that the Etango project has been having. I mean, it had one in 2015, and then you also updated it it had the first one in 2012, excuse me, then you updated it in 2015, if I'm not mistaken. And also, sorry that I'm continuing here, but you're also doing a front-end engineering and design study, FEED study as they call it, after this one too, and a final investment decision, I'm assuming. I'm just wondering, why is that? So to help me understand, this comes from my lack of understanding of the general mining and development process, but help me understand why all that money has to be spent on all those studies if you already know that the project works at $65.
Well, it's a little bit like if you're building a house. you might design it to a certain level, and that's good enough to get it into the council. But someone has to choose what bathroom fittings you're doing, what kitchen fittings you're doing. And if that decision is made by someone like my wife, you need someone who's being very careful about what's being spent at the same time. In this example, you go through a definitive feasibility study, but you've then got a subsequent set of plans, so to speak, which is your detailed design. So it would be a huge waste of money to do detailed design at the time of definitive feasibility, because part of the exercise of feasibility is to make sure that the project's viable and understand under what circumstances, e.g. $65 a pound, it flies. So you do it in iterative steps. What would normally happen is you would take your DFS, raise your finance, and then use the borrowed funds to commence the front-end engineering and design and the detailed design. Now, we've made a strategic decision to use equity to do that so that it can keep us moving forward. It's also very important in the current environment of cost inflation that we move forward with the front-end engineering and design, because that maintains the continuity and the freshness of our DFS. 6 months is a long time with cost moving around and supply chain bottlenecks and so forth. So by maintaining all of the engineering team in place, working on all of these aspects through front-end engineering and design, we're keeping this fresh, we're keeping it current, and we're making sure that we understand the costs of this project at any point in time, rather than taking your DFS, putting it on the shelf and then wondering, well, is that still a reasonable assumption for acid? Can we really rely on that number for power now? What about concrete? How much is steel going to cost? What about our crushers? Have they gone up? Can we still get crushers? There's a whole lot of aspects of this that we need to really keep our finger on as we get closer to the point where we'll be financing and constructing this mine.
You mentioned that the costs are moving around, and I agree with that. I spoke to a couple of companies about that, including Kazatomprom. And with inflation being as unpredictable as ever right now, that's definitely a challenge. Some of those companies, actually, including Kazatomprom, are struggling to even get materials and equipment delivered on time and on budget to be able to build new production wells, for example, in their case with the ISR, which obviously that results on some occasions, in their case specifically, to 30 to 40% higher expenses. Now, you just went from a PFS to a DFS in sort of the same period that these other companies were announcing higher expenses. But your CapEx only went up 16%, if I'm not mistaken, and your OpEx actually went down 5%. Is that how is that getting determined? Is it is it? I'm just trying to figure out if it's really a realistic guess and how it comes up to it.
Yeah, well, look, it's been an outstanding result to have your economics on a holistic basis pretty much match your PFS, which is what we've got here. You know, OPEX is down, CapEx is up, and when you look at it holistically, you end up pretty much in the same place with Etango. That really underscores the outstanding job that the Bannerman team and its consultants have done. There's no guesswork here. The nice thing about a definitive study, and also the challenge of a definitive study, is everything needs to have a really solid basis behind it. So we don't just put in a spreadsheet what our acid prices are going to be. We've got an MOU with an acid supplier. When it comes to power, we've got an offer from NamPower. When it comes to water, we've got a written confirmation of availability of water and what the price would be. When it comes to contract mining, we go out for a series, we put out requests for tender, and we get quotes coming back from contract miners saying, if you choose us, we will contract mine for this amount. So the word definitive is designed to really constrain the feasibility process to numbers that you can demonstrate and verify in quite a precise way. And that's one of the main things that evolves as you move from a scoping study or PEA, then to a PFS, and then to a DFS. And it's also one of the reasons why a lot of companies are reluctant to issue DFSs. And I'm not just referring to uranium, I'm talking about across the metal sector, when there's so much cost inflation, because We hear a lot of rumors about companies that have been utterly blown out of the water by their DFSs. So we've been fortunate. Part of the reason is it's been two-way traffic with us. It hasn't just been cost inflation challenges. There's been a number of examples where we've been able to achieve some wins in this process. We've had a reduction in our power cost, for example, through bringing in 30% independent power producer solar. So we're in a desert in Namibia, so up to 30% is still viable and gets your power cost down. We've introduced some power consumption savings into the processing. Our water costs have gone down. Our acid prices we've managed to keep about the same through doing an MOU with a local acid supplier who otherwise would be exporting that acid. So it's a win-win. They don't have to put it on a ship, and we get local acid at a price that under the MOU is kind of constrained by floors and ceilings. So the other thing that I'd say, and the other thing that would help you understand how we've been so successful in constraining those capital costs, is we've got a real advantage in Namibia. The Namibian dollar is pegged to the South African rand. And as I'm sure you're aware, and your listeners are aware, I mean, South Africa is a very, very substantial mining centre. So a lot of what we need and a lot of what we can get comes from South Africa, whether it's contractors, concrete, steel, a lot of the equipment. And the South African rand continues to depreciate against the US dollar. So we've had a win by virtue of exchange rates that has really buffered the capital costs that we otherwise would be experiencing. So that's just one of the benefits of the many benefits, I would say, of being in Namibia, and particularly at this time.
I'm hoping to talk about that too at a later point today. Even at those cost levels, though, you ran your DFS at $65 uranium, as I just mentioned. That gave you at an 8% discount. That gave you roughly $210 million US dollars of NPV, if I'm not mistaken. Now, first thing that I would do, you tell me if that's right or wrong. First thing that I would do is when I see a DFS, I would check at the NPV number, and I would relate it to the market cap of the company. You're sitting at around 170 million US dollars, if I'm not wrong here. So that means some 23, 4, 5% upside would bump your share price to one-time NPV. Would you say that one-time NPV is a fair valuation for Bannerman at its current state?
So to take the first part of your question, Antonio, that's pretty fair enough if the company was purely represented by what you saw in the DFS. So let me give you an example and reduce it down to numbers. So the Etango 8 DFS involves an 8 million tonne initial development of the Etango project with an ore reserve, a mining reserve of about 60 million pounds. So if that was all the ore that there was, so that was all the uranium that was at this project, and it was only 3.5 million pounds over the 15-year mine life that we talk about, then I think that would be fair enough. And then we would be having the debate about whether one times is appropriate or not. But we're a bit different in that respect. And that 60 million pounds comes out of a total resource of over 200 million pounds at Etango. We've also got two very substantial satellite deposits within easy trucking distance, either of which would be a company maker for a junior first listing on the stock exchange. And the development pathway with Etango 8 is we start at 8 million pounds, and then it's modular. So if we see the market behave in the way that we expect, and we see uranium prices behave in that way, then we can increase. And when I say we can increase, as you mentioned, we've done a definitive feasibility study at this company before, and we did that into 20 million pounds, 20 million tonnes per annum, which generated 7.2 million pounds. So we've already determined at a definitive level that it's technically viable to produce at that much higher level. And the mining reserve for that DFS was 130 million pounds. So it's not even one of those situations where we're saying we think the ore body's bigger and we can drill out a bit more and continue expanding the mine life. We've drilled it out to an ore reserve status that's more than double the ore reserve of the Etango 8 project. So what does that mean? Well, first of all, it means there's a lot of pounds on the ground that wouldn't be valued by just taking the NPV of Etango 8 at $65. It also means that there's a lot of upside potential in the form of expanding that production and the extension of mine life, which has a strong strategic value for this company. If I give you an example, the Rossing uranium mine just down the road, that's probably the best analog and one we know very well because our chairman in Namibia was the MD when it was the largest uranium mine in the world. When that started in the 70s, it had a mining life of 16 years. Now, as many of your listeners would know, Rossing's still a large producer of uranium 45 years on, and it's now looking at a cutback where it might expand for another 10 years. And the ore body is very similar with Etango. We could expand our 225 million pound resource just simply by drilling more holes and drilling deeper. But it doesn't make sense to do that right now. Then look, the final thing I'd say to you is we're very leveraged to the uranium price. So sure, if you put in a $65 price assumption, which we presented as a base case with this DFS, then you end up with the comparison that you described. I personally think that that's quite conservative. And as a result of that, we presented $80 a pound as an alternative that investors can analyze our numbers with. And when you look at $80 a pound, we're more than double the NPV, post-tax, mind you. Now, you start plugging in numbers above that, and you start to see from the sensitivity analysis that we've done that our project really starts to explode from a cash-producing point of view. If we see the uranium market develop anything like it did during the last uranium boom. So there's a lot of latent value in that. There's a lot of option value in that that I think justifies a market cap well above the NPV post-tax that's been pegged to $65.
I think that's a good and an important answer too, because it's generally different in other commodities that are less volatile. Because if a gold company would come out with a DFS calculated at 30% above the spot price of gold, they would get a lot of flack for that, about not being conservative enough or something like that. I guess it is. That's what you're trying to say, is that it's different with uranium because the price is under the incentive price for production. And I guess to that point also, you're calculating, you're giving the upper case with $80 uranium. Your base case, you're calculating with the uranium price at $65. That means that you expect the price of uranium to be there or higher by the time you're in production. So, and that could take 3 years, I believe, after the final investment decisions, if everything goes as planned. But you're also expecting it to stay there or even go higher for the life of mine, for the 15 years that you're going to, or possibly, as you said, longer, that you plan on being in production. If it's well, yeah, I guess it needs to stay a while longer too, because you have to build and also then close it at the end. And it needs to stay there at least for 4 years if you want to pay back the capex to begin with. And we'll be talking about that. We'll be back to talk about the DFS here in a second. But do you think it's reasonable for uranium to stay that high for that long during this cycle, given that the previous cycle that you just mentioned and all the other previous cycles, they have been rather short-lived? Sure, the last one was very violent, but they are they're big spikes, but they're short-lived.
Yeah, absolutely. I mean, let's talk about the oil crisis. That was a bull market in uranium where, in real terms, and you can see a really handy graph from this if you go to section 11 of the executive summary of our DFS. In real terms, the uranium price went well above $200 a pound, and it stayed there until 3 Mile Island basically caused the nuclear industry to cave. And that is the best analog, I think, for where we're at the moment in the nuclear power industry, rather than 2006, 2007, which was, let's just call it, a bit frothy. The reason I say that is all of the elements that caused the factors behind the oil crisis in the 1970s are pretty much what we're seeing today with the energy crisis. Now, the drivers are a little bit different. It's, it's not conflict in the Middle East. It's ESG factors and it's decarbonisation, and now it's conflict in Europe. And when you look structurally at what's the uranium demand growth that is expected over a sustained period of time, it's not like that's just going to get filled in. Even with the exceptional exploration that we're seeing in the Athabasca Basin at the moment, the growth will outpace that. And so it's going to need a long-term sustained price at, I believe, those levels and potentially above when you start factoring in inflation. So I'm pretty comfortable with those numbers.
Mm-hmm. Sure, let's hope you're right. I mean, I'm in it to win it, so I do hope you're right. Let's go back to the DFS though and talk about, because I mentioned that you might need at least 3 years to get into production after the final investment decision. Why don't you walk me through those timelines more specifically? When is that final investment decision coming? And then when do you start cash flowing? When do you ramp up and stuff like that?
Yeah, well, Antonio, as you saw from our release, we're not going to paint ourselves into a corner by providing dates and times, because we're going to do it when it makes sense for shareholders. And what that means is we're going to put ourselves in a position where we can push the button when uranium prices are where we think they will enable us to lock in the most shareholder value and an appropriate amount of shareholder value. So in practice, what that means is we will wait for term contracting to give us the opportunity to write a portfolio of contracts that on the downside enables us to achieve financing, and on the upside enables enough flexibility that we can take advantage of any temporary spikes or any long-term corrections to the incentive price that creates that type of price growth that we've been talking about. And there's very few companies in this sector who are genuinely in a position to press that button at that time. It's a very different proposition to actually lock in prices that give you that exposure to the growing uranium price, as opposed to putting those price assumptions into a spreadsheet that underscores a share price. And that's really the evolution of our company over the last couple of years. We're now in the former position rather than being with the other large number of uranium companies who are in the latter position. And as I might have even said on your show before, you can't mine a spreadsheet. You can only mine an ore body. And to do that, you need to have your permits, you need your environmental approvals, you need your technical studies like this DFS, you need your feed and your engineering and your detailed engineering and design, and you need your finance. And so that's why releasing this DFS was a really big step. Not only did it tick the DFS box for us, and it ticked it really well, but it also becomes an enabler for all of those other aspects. We do already have our environmental permitting, but having the DFS done now means that the Ministry of Mines and Energy are in a position to process our mining license application, hence why I'm in Windhoek at the moment talking to them. It enables us to talk to utilities, it enables us to talk to financiers. So the DFS is both a milestone in its own right, but it's a enabler for all of these other really important processes. And I feel like that's what's really now elevated Bannerman into rarefied air. We've got those numbers, people can really understand the project, and we can commence all of those important work streams.
Okay, I understand. Fair answer. Really why I brought that up is because I was hoping to talk about potential buyers, speculate really about potential buyers, because you look around you and you see the Chinese controlling two of your closest neighbors, if I'm not mistaken. Paladin also controls another one of your neighbors. Their deep yellow is not too far off. So I was just thinking whether you're at liberty to talk to me about who you're having dinner with. Don't tell me who's putting offers on the table verbally if you can't, but who are you having dinner with? If you can tell me about that.
That's not our strategy at the moment. We're now in a position to build the mine. We anticipate and expect and have a lot of analysis to back the forecast that we'll see uranium prices that enable us to build the mine. And we've got the team and the confidence by virtue of this DFS and the feed work that's been done to build it. So that's the direction that we're taking, Antonio, and we're putting all of the steps in place to be able to do that. Halfway through this year, we engage debt advisors. So we don't have a corporate group who are looking at M&A transactions for us. We've got a very well-respected group out of Sydney who are analysing what financing would look like, what export credit agency financing would look like, what offtake financing looks like. So there are a number of companies in this sector who are obviously moving more towards the way that you're describing it and doing the dinners and all that sort of thing, but that's not our approach.
Talk to me about the financing then. What would that look like? Do you have any idea there?
Yeah, it's what we've been doing is focusing on what a base case financing looks like. So a conventional financing, the way you'd finance a copper mine or a gold mine, for example, syndicate of banks. And so our debt advisors have been identifying what the range of lenders are who are happy to lend into Namibia, happy to lend to uranium, what their requirements are, any particular quirky requirements they've got, understand in detail what their ESG requirements are, how they report to Equator Principles. There's a huge amount of depth that's gone into the work that they're doing. So what that enables us to do is it enables our board to understand what that baseline financing looks like, so that we can then formulate the corporate strategy about moving forward. And we're confident that it would be there. And we understand what would be required from a contracting point of view in order to meet debt coverage ratios and all of the stuff that goes with the financing. Now, the nice thing is once you've got that baseline fairly firmly well understood, we can then say, well, how could we optimize that? How could we lean more heavily on export credit agencies to get more favourable terms? How might we look into potential offtake financing opportunities? How might we use off-balance sheet financing to achieve better result for equity holders? How might we partner with our very large-based customers who've got multi-tens of billion-dollar balance sheets to achieve a better cost of capital? There's a very broad range of options that start to open themselves up once you've got a DFS and once you can start talking to these parties with real numbers that are current, where you're not kind of giving a disclaimer the whole time saying, well, these are 12-month-old numbers or 18-month-old numbers. And the interesting thing about our project and what makes it have a real X factor is its strategic value. So it's very long life. I would expect it to be a multi-decade mine. That's very attractive to nuclear utilities because they're trying to look for supply to match off against multi-decade power stations. The expansion capacity from the 8 million tonnes generating 3.5 million pounds to something modular, something larger, that's also attractive to utilities because the big utilities in the world, they're expecting to need to build a lot more nuclear power stations, but they don't know that yet. They can't be writing contracts for the power stations that they've got in planning. But to know that their partner or their supplier in a Bannerman and in an Etango has got the capacity to bring on in a modular fashion additional production, that's really attractive to them. So it starts to change from being purely a buyer-seller type relationship to a much closer relationship. And that's the opportunities, the win-win opportunities for our customers, of course, because it secures production. A win for Namibia because it gets more employment and taxes and royalties and all of those good things and development. And, of course, a win for shareholders because typically those arrangements are value accretive for equity.
Who are those shareholders that you would be raising money from? Maybe not specifically if you don't know that yet, but would you expect those to be a mix of retail investors and institutional investors? And if that's so, wouldn't you be better off with a North American listing?
Raising money from in what sense?
Raising money in terms of share issuance, private and public offerings.
So you're working on the assumption that we go down the base case conventional financing that's got a debt equity split?
Yeah. Sort of, yeah.
Okay, all right. So let's work on that in that scenario for a moment. That's the base case scenario. Look, that'll be determined by the market at the time. That'll be determined by institutional interest, be determined by liquidity in the uranium market, which will be driven largely by sentiment in the broader equities market. There's a whole bunch of considerations if we even find ourselves in that situation. Typically, with let's leave Bannerman for the moment, but talk about a typical mine financing with a split of equity and debt. Very rarely is that done from retail shareholders. It's almost entirely done from large institutional funds who can, write $2, $3, $5, $10 million checks. And those institutions are exchange agnostic these days. They're sophisticated enough to be trading on the ASX or the TSX or the New York Stock Exchange or AIM. So a North American listing wouldn't offer any real benefit if we found ourselves in the scenario where we were looking for additional institutional capital to come in by a private placement.
Okay, that makes sense. I know that you almost have to go here in about 10 minutes, and I do want to talk about the risks. I think that the risks of putting a mining company in production are just not talked enough about, because there's a lot of exciting things to talk about. I understand that. You've seen the numbers, they're definitive, you're excited to go ahead and put that in production. I get it, but there's always things that could go wrong. So why don't you tell me about that? What keeps you awake at night? What are you thinking about? What are you trying to solve in your head?
Well, the main thing is the development of the uranium market in two respects. So first, in an absolute sense, how soon is it going to get to those sort of prices that will support a contracting portfolio? But it's also a little bit more nuanced when you sit on my side of the table, Antonio, because at some point, I'm going to have to make a recommendation to our board that now is the time to go, because the way that the real judgment call, the magic in this judgment, if I can put it that way, is understanding the market well enough that you can, even in the face of good prices, when to wait for better prices. But equally, when you get those better prices, not to wait longer for even better prices that might not materialize. So when you're in a shareholding situation, if you're a shareholder, you've got buy and sell decisions to make. But in this case, it's a little bit like that, except it's on behalf of an entire project that's got numerous stakeholders, including a country where this project is of national importance. So if there's something I obsess about, it's exactly that. It's understanding the market and making sure that I'm in a position to have a sufficiently nuanced understanding of the uranium market that I can make those timing calls at the right time to achieve that balance between getting into production, but also preserving and enhancing the shareholder value.
Does you not yet making that call, given that it's going to take at least 3 years to build the mine, does that mean that you don't expect the uranium price to be at 65 in 3 years?
You'd be locking in the bulk of the contracts ahead of FID. Now, a contract isn't just and I know you know this, Antonio, and we're going into this for your audience, but a contract's not just a fixed price escalated contracts. You get a whole portfolio. You get the opportunity to design a shape of your pricing exposure to the market going forward. And that would be a combination of fixed priced escalated. So it's pick a number, and then it might escalate according to inflation or according to your costs or whatever it might be. But you also get market-related contracts that are subject to floors. And typically, if you get a floor from the utility, you have to give them a ceiling to cap their risk as well. And then you have other forms of contracts that can provide effectively derivative value within your portfolio. So to an extent, we will need to be choosing the timing at which we write those contracts, because the current market will heavily inform the negotiation. you'd be looking at where the market is to understand what's reasonable for a floor and what's reasonable for a ceiling, for example. But it's also about your view 3 years out when you actually are delivering into those, because any of the flex that you've got into those contracts will be determined by the price at the delivery date and whatever pricing formulas and whatever pricing calculations that you're doing within that portfolio. So it's a twofold decision that needs to be made. And so that's why it does need a very nuanced understanding of the market.
Sure. You also mentioned the one of the largest stakeholders in this business model that you're going with is the country. It's the jurisdiction. And I know you like Namibia a lot, and I understand that it sits high up the uranium exporting ladder, and that a lot of the GDP of Namibia actually depends on mining uranium. I understand all that, but there's also there seemed recently to be some type of troubles in Paradise Sotocom. There was I read something in the news, something happening at the Ministry of Mines and Energy there. I didn't go looking further into it because I know I was talking to you, and so I thought I'm going to ask Brandon about it. So what's happening there, and how big of a risk do you think changes like that can be?
So what Antonio is referring to for everyone out there is that the mining commissioner was replaced in Namibia, and that was on the back of, or as a result of, the local newspapers here publishing allegations of corruption. And the corruption was in his team, or in his ministry, or the allegations, I should say. And I suppose the good thing about it is someone had to be held accountable for that, and someone lost their position as a result of that. Now, that can lead to issues for companies. So that's a person who understood our project really well. We've invested over more than a decade bringing him along and understanding all of that. So there's a risk associated with losing that knowledge. You can end up going back to the beginning. I know him well. We've got a really healthy respect for each other. And now it's a case of starting again. Now, luckily for us, we know the new mining commissioner. She was in the geological survey, and this is a survey in a mining industry that I've been really involved in since 2009. So that's a risk that we didn't have to deal with. And the reason I'm in Windhoek at the moment is on Monday, before we released the DFS to the ASX, I went and presented it to her as the new mining commissioner, and we spent an hour or so just talking through it. So we're fortunate in that she's got a good understanding of the project, and a couple of the people around her have. And we had the opportunity, by virtue of her being new and being curious in this particular role, that we were able to have a really frank conversation about what we need from the ministry. What she asked us point blank, what does support look like? Okay, great. Support looks like this. If you can do this, if you can do that, if you can do that, that's going to make our life easier to bringing this project on. So in terms of risks, they're really the main ones, and I don't feel like they're affecting us. There will be other companies who will have to build that relationship from scratch, etc. But Namibia is pretty easy like that. They're very accessible. It's a small community here. There's only 2.5 million people. You can go in and you can just chat to the minister, which is what I did on Monday. It's that type of a place. It's a bit like a big village. There isn't a whole lot that you need to wade through to be able to have a conversation with people, because that's what it is in this environment. If you're referring to the allegations of corruption themselves, I suppose the courts will determine how much truth there is to that. It is a free media here, so they can publish things that they think or that they believe. And Africa, like most parts of the world, does have corruption. In Namibia, we've never faced it. So I've never, in the whole time I've been operating here since 2009, been asked to make a facilitation payment, pay a bribe, do any of that sort of thing. Do I think it exists? Well, it does, in the same way that it exists in Australia and the US and Europe, what I can tell you fundamentally is that the corruption in Namibia is nothing like what it is in most of its neighbours. Probably it's akin to Botswana, which is a very clean country as well. But it's nothing like what you would have read about in South Africa or DRC or Zimbabwe or Zambia or, pretty much the rest of it. Namibia with Botswana really sit in their own league when it comes to Africa, in terms of all of those operating jurisdiction aspects. So, that's probably all that I can really tell you. I don't know anything personally about the particular cases that have been cited in the media, so I can't even give you any colour on how reasonable those accusations really are. All I can say is the media raised corruption as an issue in the mining industry, and someone was held accountable for it and lost their position as a result.
It's good to talk about these things to someone who's on the ground, because when you say there's corruption everywhere, there definitely is. There's I guess a general belief that there's not as much corruption in Western Europe or the US or Canada. That's just not true. They just know how to hide it better, I guess. Something else that is talked about, though, especially when it comes down to Africa, is water. And I guess, first of all, your external infrastructure CapEx, you gave an overview in the summary of your DFS. The highest cost by a large margin on the external costs for the CapEx are the water supply costs. And then again, too, it's also 15 years at least, you hope for even longer life of mine, that you have to have your water supply for. But if it's a prominent region for uranium exploration and mining, if other companies start showing up and start competing for the same source of water in that one region, how are you going to manage that, and how are you protecting yourself against those risks?
Yeah, well, I suppose the good news and the bad news is that we use desalinated water. Good news from a environmental point of view. Bad news because it's expensive. It's expensive water, and that's in there in the in the DFS. Obviously, fully allowed for the water price assumption. Going back to one of your earlier questions, Antonio, the water price assumption is off the back of a written offer. So we understand that number really well. And there is CapEx because we need to build pipelines that transport it from the Swakopmund Reservoir. Luckily, we're the closest uranium project to that reservoir, so we've got the shortest pipeline of anyone else, and that helps us as well. The other reason that it's a good news is because it's just simply an industrial process. So if other mines come along, well, then that's great, because they'll build more desalination capacity, which will probably increase the economies of scale, and therefore probably make our water cheaper. So the point is that once we're in the system, they're not going to leapfrog us. They're going to have to form their position behind us, and we're fortunate because there's existing capacity that we've been given a written confirmation of availability for ourselves. So what's been already built, we can just tap into. As explorers have success and as new projects come along and as new projects get built, well, they won't have that excess capacity to tap into in the same way that we have, and they'll have to build that. But again, as I say, it's just simply an industrial process. There's no shortage of water in the sea. So that's a good thing for the development of the uranium mining industry in the Etango region of Namibia.
Definitely is. I hear you there. Brandon, you got to be gone in 2 minutes, so I'm going to go ahead and wrap it up. Is there, I have, I guess, a couple of more topics, but is there something specific that you hope to talk about when you came on, but I failed to bring up?
I think we've covered it. It's I don't think I've thanked everyone yet, but I'm really, really grateful for the team. It's been an incredible effort. The dedication amongst everyone, both the owners team and the consultants, has been extraordinary to observe. There's a lot of work that goes into one of these. The report itself, excluding the attachments, is 956 pages. So someone's written all of those pages, or rather a bunch of people. We've had 84 people involved in this, almost 20,000 hours from our owners team involved in this, 14,000 hours from our lead engineer. It is a very, very big undertaking that then gets distilled all the way down into a 122-page document and a short presentation, just to make it more palatable, more accessible, I suppose, to the investing public. So, I'm really impressed and really proud of the job that the team's done, and very grateful for that.
Yeah, well, I didn't.
And I'm also grateful for you, Antonio, because what the listeners won't realize is I've pushed this interview back about 4 times because I've just been just come back from government meetings here in Windhoek, and they're very unpredictable how long they go for. So thank you for bearing with me.
It's absolutely no problem. I don't really have as much to do as you do, so I appreciate you investing your time in me and walking me through this. Thanks for being here.
Thanks, Antonio.